exercise 1, we have sales of machines on credit in 2018, where the sales price depends on the number of units sold. More than 200 machines or more, the sales price is 3 per machine. Fewer than 200 machines, the sales price is 5 per machine. Hence, as of each date, we recognize revenue based on the expected number of units sold as of each date. More than 200 machines or more, 3. Fewer than 200 machines, 5. Whereas receivables are recognized based on actual units sold as of each date, not expected units. Based on differences between receivables and revenue, we recognize refund liabilities. So for example, March 31st, 2018, actual units sold in 2018 were only 60, less than 200, hence receivables is recognized based on a price at 5 per unit. Therefore, receivables 60 multiplied by 5 or 300. But expected units sold in 2018 are 240, more than 200. Hence, for revenue, the expected sales price is 3 per unit. Therefore, sales revenue 60 multiplied by 3 or 180. For this difference of 300 receivables, 180 revenue, we recognize refund liabilities 120. For June 30, 2018, our actual units sold are 90 and 60 in the first quarter, 30 in the second quarter. Hence, receivables 5 per machine. We sold in the second quarter 30 machines. Therefore, receivables 150. Expected units sold are 180, less than 200. Hence, the expected sales price is 5 per unit. Therefore, sales revenue, likewise, 30 machines, 5 per unit, hence 100. In addition, for journal entry A on June 30th, 2018 is for machines sold in the first quarter, where receivables and revenue are recognized based on a price of 5 per unit. Journal entry B is the adjustment for machines sold in the first quarter. As of the end of the first quarter, the expected sales price was 3 per machine. As of the end of the second quarter, the expected sales price was 5 per machine. Hence, the expected sales price has increased by 5 minus 3 or 2 per machine. In the first quarter, we sold 60 machines. Hence, revenue increases by 120. The 60 machines sold in the first quarter multiplied by the increase in the expected price per unit of 2. So receivables, so we have this addition, we have this adjustment for refund liabilities. Refund liability is measured in this case as receivables or that are recognized for consideration. The firm does not expect to have a right to collect. In this case, consideration, the firm expects to have a right to collect increases by 120. Therefore, refund liabilities declines by 120 as a result of the adapting or reduced refund liabilities by 120. So September 30th, 2018 and December 31st, 2018, we have the same types of journal entries. Journal entry A is to recognize revenue for units that were sold in the current period. Journal entry B is adjustment for revenue for machines that were sold in previous periods. This adjustment in B is based on the changes in the expected sales price from the end of the prior period to the end of the current period. For example, September 30th, 2018, the expected sales price declined from 5 per unit to 3 per unit. The 90 machines sold in the first and second quarter, 60 units in the first quarter, 30 units in the second quarter. The expected sales price declines by 2 per unit, hence revenue declines and refund liabilities increases by 180. So December 31st, 2018, the same type of journal entry, except for a decline, except for an increase in the expected sales price from 3 to 5. So that's just exercise 1. Are there any questions on exercise 1? Not yet. Yeah, so there is a question here. Okay, so there was a receivables. So in the lecture on March 31st, I will so there's a question about why in this exercise we separated refund liabilities, or we have refund liabilities on March 31st, but in the example from the lecture, we did not. So in the example from the lecture, we had from the lecture, we had, well, I guess we can start with the example from today's session. So in the example for today's session, for the exercises, we had, as of March 31st, 2018, we had sold 60 units in 2018. Hence, receivables was based on the actual units. The receivables is based on the actual units sold of 60. Therefore, we recognize receivables based on a price of 5 units. Hence, receivables is 3. And sales revenue is based on the expected number of units sold. As of March 31st, 2018, we expect to sell 240 machines. Hence, the expected sales price is 3 per machine. Therefore, we have 180 in sales revenue. As a result, we have a difference between the receivables and revenue of 180. In cases where you have, in these types of events, when you have differences between receivables and revenue, you recognize refund liabilities based on this difference. So we had 300 receivables, 180 in revenue, and refund liabilities was 120. So, in this case, another way to state this is that receivables is based on a price of 5 per unit, revenue is based on a price of only 3 per unit, hence we have to recognize refund liabilities based on this difference of 5 minus 3 or 2 per unit. We sold 60 units, hence refund liabilities for 120. In the example from the lecture, receivables and revenue were based on the same values. So receivables and revenue were based on a value of 10 per machine. Hence, we debited receivables and credited sales revenue for 200. Therefore, receivables and revenue were the same. Hence, we did not have a difference. Therefore, no refund liabilities. So that, okay, you're welcome. So how do we get 700 in trade receivables in December? So let's see how this happens. So, the second question, 700 in trade receivables in December, where sales price is 5 per shirt, hence the revenue is 350, 70 shirts that we expect liabilities, credit cash 100, the value of the cash paid to customers as a refund for shirts that have been returned. In addition, we have recovered 20 shirts. These shirts are inventory with a carrying value of 2 per unit. Hence, inventory increases and recovery assets declines by 20 shirts recovered, multiplied by the carrying value of 2 per shirt, hence 40. May 31st, the return period expires, and intended shirts that we expected would be returned were not returned during this period. Hence, we recognize revenue and COGS for these 10 shirts. Therefore, May 31st, sales revenue by 10 shirts that we expected to be returned but were not returned, with the sales price of 5 per shirt. Hence, revenue 50. We no longer have a liability to provide a refund for these shirts. Therefore, refund liabilities declines by the same amount of 50. For COGS and recovery assets, the 10 we recognize revenue for these 10 shirts. Hence, we now recognize an expense for these 10 shirts. In addition, we no longer have a right to recover these 10 shirts. Hence, COGS increases and recovery assets declines by 20. 10 shirts multiplied by a carrying value of 2 per shirt. So that is May 31st. To recognize revenue and COGS for the 10 shirts that we expected would be returned, but were not returned. There are no questions on exercise 2. We can come to exercise 3. And as we're going through the solutions, if you have any questions, please write these questions in the chat or just start talking into the microphone. Exercise 3, we have a contract with 2 performance obligations, the provision of machine X and machine Y. We have to determine the value of revenue to recognize for the provision of each of these machines or for the satisfaction of each of these performance obligations. On June 15th, when we provide machine X, revenue is 375, July 31st, machine Y, revenue is 125. These values are based on the transaction price of 500, cash received from the provision of machine X and machine Y, multiplied by the relative standalone sales price of each item. The journal entry for June 15th, 2018, it shows this calculation for the relative standalone sales price of each item. Machine X and machine Y have a standalone sales price of 450 and 150. Hence, machine X accounts for 75% of the combined standalone sales price of these 2 items. Machine Y, 25%. Hence, we allocate 75% of the transaction price to machine X and 25% to machine Y. Therefore, June 15th, 2018, when we provide machine X, sales revenue is 500 transaction price multiplied by 75% or 375. July 31st, we provide machine Y, sales revenue is 500 transaction price multiplied by 25% or 125. That is exercise 3, where revenue is recognized for the provision of machine X and machine Y based on the relative standalone sales price of each item. And the calculations for the relative standalone sales price are shown here in the journal entry for June 15th. So if there are no questions on 3, we can come to exercise 4. And with exercise 4, there's a typo in the solution. On the first line of journal entries, it should be January 1st, 2018, December 31st, 2018, and December 31st, 2019. So I'll fix this, or I will correct this mistake when I send you this file later today. So in this case, we have a contract with a significant financing component where we receive cash on January 1st, 2018 for a machine that we will provide, or a building that we will provide on December 31st, 2020. Hence, over the lifetime of this contract, we will increase contract liabilities so that as of December 31st, 2020, the value of sales revenue that we recognize is greater than the value of cash received on January 1st, 2018. These journal entries where we debit interest expense and credit contract liabilities are for beginning contract liabilities multiplied value of the cash flows that we will receive over the lifetime of this item, of this contract. So as of December 31st, 2018 and 19 and 20, we received 100 in cash, discounted at 5%. The present value of these cash flows are 272. In January 1st, 2018, receivables and revenue 272. The present value of the cash flows that we will receive over the lifetime of this contract. As of December 31st of each year, we have two journal entries. One is to increase receivables and to recognize interest revenue equal to beginning receivables multiplied by the discount rate of 5%. For example, December 31st, 2018, 272 multiplied by 5%, hence 14. In addition, we receive 100 in cash as of December 31st of each year. Therefore, cash increases and receivables declines by 100. As a result, debit cash, credit receivables, 100. So we have the same types of journal entries for 2019 and 2020. So if there are questions on exercise 5. So exercise 6, first we calculate the ending allowance for doubtful accounts. We make this type of provision matrix where we multiply the value by the loss rate for each of these three groups of items, or these three groups of receivables. ECL for each of these three groups is 30, 60, and 40, hence the allowance. So we have not yet past due, value 600, loss rate 5%, hence ECL 30. Went to 90 days past due, value 300, loss rate 20%, hence 60. And over 90 days past due, value 100, loss rate 40%, hence 40. The AFPA is the sum of these items. So the journal entries are here for November 1st, 2019. We expect 20 in defaults from specific accounts, so we have 20 in write-offs. Hence, we debit or reduce the AFDA and we credit receivables for 20. December 31st, 2019, we recognize bad debt expense. We calculate bad debt expense using equation for bad debt expense, ending AFDA minus the beginning AFDA plus write-offs. We had the ending AFDA of 130 from calculated here. We have the ending AFDA of 130. We had a beginning allowance for doubtful accounts of 30 given information. Write-offs were 20 on November 1st, 2019. Against bad debt expense is 120. 130 minus 30 plus 20. Therefore, we debit bad debt expense and credit the AFDA for 120. So this is the equation that we use to calculate bad debt expense. So that is exercise 6. Again, I will send you this file at the end of the day today after the last group has had their session. So if there are no other questions, comments, etc. about these exercises or this course, we will be finished